Craig Bolanos joins us now, co-founder and wealth advisor at VestGen Wealth Partners. Get retired, stayretired.com. Craig, how do you assess the market today?
Well, it's a little disappointing. I mean, October was much more treat than it was trick, so I'm disappointed that November's in the red. But I think it's a normal period of consolidation. I don't think this is the end of AI enthusiasm, but boy, this government shutdown and the Supreme Court loom large on investors' minds.
Oh, really? You think that the Supreme Court casting a shadow on the ability of the president to issue those tariffs is weighing on the market?
I think it's a part of the psychology overall, right? I mean, the real issue, of course, is what we see going on. It's the government shutdown. It's the lofty valuations after this 40% run-up in some of the tech stocks off the April lows. But I do think there is some danger there. I think it's likely the Supreme Court is going to uphold the lower court decisions that happened twice to say those are going to be illegal. And do I view that maybe as a short-term market positive? Yeah, but longer term it's more mixed. I mean, think about the One Big Beautiful Bill Act that was relying on all of that increased tariff revenue. If we can't find a way to get the tariff revenue, then that substantially deteriorates the U.S. fiscal situation.
How does it a short-term benefit?
Well, it's a short-term positive because think about all of the retailers and some of the industrial names that have really been under pressure. I mean, profit margin pressure ever since the tariffs came in. I think you're seeing some of that profit margin pressure, especially on the retail side for small to mid-sized retailers, show up in that very disappointing Challenger Gray jobs report that just came out yesterday that kind of shook markets as well. And I think if you can remove the tariffs, you get some of these smaller retailers on equal footing with the bigger companies once again.
Yeah. I hadn't thought about it in the terms you just put it, though. That is, if the government is losing revenue from the tariffs and they agreed to lose revenue with the big, beautiful tax bill, then what does that mean to the economy or the markets? You're kind of suggesting that's going to be maybe worse than we think.
I'm suggesting that's a real issue because, you know, we have to look at all things, especially when it comes to taxes and stimulus. They have to budget score. And the One Big Beautiful Bill Act, right, did rely on the tariffs. You take away that tariff revenue, now the U.S. financial situation becomes a little bit more complicated. And if that puts a upward price on the yield of a 10-year treasury, meaning we're not as fiscally responsible, and then mortgages can go up, all these different things could go up. It is a problem that should be discussed. I don't know that it gets enough attention, but those of us that are financial nerds, that's why I love your show, John, we talk about it.
Well, where is the 10-year right now? Was it 4.14 the other day? What's the number right now? Do you know?
Yeah, here's the good news. The good news is I'm going to pull up the number for you right now. The good news is I don't think we're going back to 5 anytime soon because if we had a 10-year treasury at 5, we'd be at a big mess. But we're at 4.07. That's 4.07, right around that 4.14 number that you just mentioned. And it doesn't show any signs of worry yet, but it doesn't take much to move that needle. And this Fed's in a quandary. I think it's clear the Fed's not worried about inflation. I think it's clear the Fed is going to be more worried about jobs. That's why I think despite the recent rhetoric, you are going to still get a rate cut in December.
We're talking to Craig Bolanos over at VestGen Wealth Advisors. We'll pick it up here in a minute. Bob, why don't you pick it up? How are the markets? We're talking to Craig Bolanos on the Noon Business Lunch, the co-founder and wealth advisor at VestGen Wealth Partners. You know, you were talking to us about the Supreme Court ruling, maybe. We'll wait and see what it is, about Trump and his tariffs and about the government shutdown. But what just about the inherent value of these equities? The markets are down late this week. They're giving up a lot. Talk to me about how frothy the market is, Craig.
You know, there are parts of the market that are frothy. There are parts of the market that are cheap, and value is probably perceived in the eye of the beholder. What do I tell everybody right now? This market is being powered by AI enthusiasm, and if anybody thinks a bubble is popping right now, John, there just aren't any signs that that is the case at all. I mean, I remember the Internet social media, cloud computing. I've got news for everybody. All three of those turned out to be much bigger than anyone even anticipated. I think artificial intelligence is the same. So this is a healthy consolidation. The market takes one step backwards in order to take two steps forward. That's what I think we're doing right now.
It's funny you mention that, because my first question was going to be, is it happening? Is it happening, Craig? And I don't know that I was going to infer that that was a bubble bursting, but the major correction that some people are alluding to, maybe a year from now, but I wonder if this is a sign of it coming here now. You're saying no.
No, I'm saying no. I say it's very typical that we have 2 to 3, 5% dips during a year. It's atypical. We get that 10 to 15% blow off every 12 to 14 months. We had one in April that was caused by Liberation Day. Maybe there'll be a reason to do that now. I actually don't think so. I think the dip is going to be relatively shallow as we take a little bit of the excess out of last month's gains. So fear not, everybody. I don't think 401ks, they're not turning into 301ks between now and the end of the year.
What do we make of this jobs report? If we don't get it from the government, we get it from this private company. Can you tell me much about that?
Well, I tell you what, I was disappointed. I was enthused by ADP that told me we're doing new hiring, but then when the Challenger Gray report came out yesterday, it was massive disappointment. John, I talked on your show a couple of weeks ago that once the government reopens and by the time we get to the end of the year, I think the headline unemployment number, once the non-farm payroll comes out, will be closer to 4.5%. Not 4.3. I think the layoffs are real. Everybody sees the announcement and everybody knows companies are letting people go, not because AI is replacing the jobs yet, but companies are letting workers go to free up cash to invest in AI. That's the current move that we're in. And I think we just have to worry about government psychology now, courtesy of the shutdown and how the consumer feels, much more so than we need to worry about the job layoffs that Challenger indicated.
The president said today at one of these things he does, a sit down in the White House, that the U.S. is the hottest country right now. I don't know what that means, but Treasury Secretary Scott Bessent said that he is very, very optimistic about the economy right now. What do you make of Bessent saying he is very, very optimistic?
Well, anytime we say very, very, or how about very, 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 I mean, it's enthusiastic. I'm always enthusiastic because I never want to bet against America. But if somebody said, is America continuing to attract capital? Oh, that's undeniable. We definitively are. Is America growing? We definitively are. Sure, have we seen foreign stock markets outperform the U.S. year to date in dollar terms? Yeah, but that's a lot of currency. But America's not on the decline. We're still on the rise. So I think people should be enthusiastic about the future.
Do you like some foreign stocks? What do you like right now?
Well, I think if someone says, what should they be doing? Mission number one is just rebalancing. The technology run has been so fast and so fierce. There's a lot of people whose portfolio may be as high as 40 to 45% technology if they really look under the hood. That might be a little bit much, especially given the concentration risk in the S&P. So everybody rebalance. There's other sectors of this market besides tech and communication to get involved in, other sectors of this market that are going to do very well from the innovation that comes from AI. Think financial. Think healthcare, and don't dismiss the energy market. The energy market. Energy stocks used to be 8% of the S&P 500. They're less than half of that now. A lot of things have a way of going back to normal over time. I think energy is one of those. And if you're going to continue to power AI, you got to power the world. Energy is going to be in global demand in a way we haven't seen in a long time.
What are those numbers, 8% and 4%? Because I've heard that time and again that if you are selling electricity or selling something to somebody who sells electricity, that's a good place to be. So what's the 4% number, Craig?
Oh, so when I'm just talking about S&P sector weightings, right? And what I mean by S&P sector weightings is, technology is like 36% of the market. Energy is roughly 3.5% to 4% of the S&P, but it used to be double than that. Energy used to be much more important to the S&P 500. And I think the more things change, the more they tend to go back to normal. So I do see energy becoming a larger and larger place in the S&P 500 over the next 10 years, and that might make it a very good long-term secular theme for people to be involved in.
I wonder if Jamie Dimon or anybody, any of the big financial whiz-bangs in this country are calling the president or John Thune or Mike Johnson or somebody and saying, guys, you have to end this government shutdown. Is there private sector pressure on the government? And I wonder how that's going.
You know, I'm not sure how many phone calls are being made, but I'm going to draw a line in the sand. They got to get it done before Thanksgiving. You don't get this thing reopened by Thanksgiving, then you run the risk. You send everybody from Congress back home, and then at that point in time, the longest government shutdown in the history, which is what we're currently doing, will have created enough psychological damage in the consumer that it's going to show up in the numbers, show up in the holiday spending, and we don't need that. Because America's economy is based on consumerism. Think of the airports right now, John. Yeah. I'll bet you there's people all across this country wondering, should I book that flight? Should we book that travel? Do we want to run the risk of being inconvenienced and laid over? Think about the lost revenue from that. That's all psychology. That's what's at risk here is psychology right now. That's what I need to see fixed.
A lot of the members of Congress, when they came home for that recess, or members of the House aren't in session right now anyway, haven't been doing a lot of town hall meetings. But if they had to go home for Thanksgiving, can you imagine the tenor of those town hall meetings, members of Congress, if they are still shut down? Let's see, today is the 7th, so we've got, 2.5 weeks, 3 weeks before Thanksgiving still? But I would be surprised if it goes on that long, Craig.
I would too. I would too, which means, can you imagine if it did?
Yeah.
Right? So I'm not saying it's going to. It's got to be solved. Someone's going to blink. Everyone needs to be grown-ups in the room and do their job. I understand representing your constituents, but it's not about winning. It's about losing less and compromising. So, perfect is the enemy of done. My message to Congress, go get it done.
Craig Bolanos is the co-founder and wealth advisor at VestGen Wealth Partners. GetRetired, StayRetired.com. Thanks, Craig.